What would you do if the Federal Reserve did not cut interest rates all the way into next year? Would you be okay? What about your mortgage? How would your debt be affected? Well, the economy is certainly hoping and praying that we are going into a time of easy monetary policy. There's just one issue. Jerome Powell said it ain't happening. In today's video, we're going to break down what Jerome Powell had to say, how this affects you, and I'm going to look at this in depth. We are going to analyze exactly what's going on each step of the way. Let's begin. In today's assessment here, I'm going to be looking at a few things that came out of Jackson Hole. This is the biggest meeting of the year as it relates to central bankers. He had a few things. I'm going to tell you right off the bat, a lot of it is the same old, the message that he gives at each individual conference. My name is David Quintieri, and what I do here at this channel is do all that boring stuff so that you don't have to. I'm not going to feed you what I think that you would love to hear and it gets all the clicks. I'm giving you the stuff that you absolutely have to know so that you are more prepared for what is coming, what we're dealing with right now. There's a big shift, and if we're not going to be prepared for it, of course, we're going to be sidelined. We're going to be sideswiped, and so we've got to be able to take this head on. What Jerome Powell had to say is very important. Not even if you could be completely outside of the US, it's still important because all the central bankers are coordinating. Fed Chair Powell calls inflation too high and warns that we are prepared to raise rates further. The market was absolutely dying for this just a little bit of a sense that this was the point of a cut, and yet it was not the case. Okay, I look at all of the information related to the central bankers, and this one, they weren't too happy about it, let me tell you, okay? While acknowledging that progress has been made, the central bank leader said that inflation is still above where policymakers feel comfortable. And so they wanted to be able to get back to this 2% goal. They kept talking about the 2% goal again. A strong economy and decelerating inflation also give the Fed room to proceed carefully at upcoming meetings. And I think what they took from that is simply that maybe they're not going to increase interest rates at the next meeting. And that would be make the markets very happy, let's say. We'll see. More interest rate hikes may be still on deck. Federal Reserve warns, same information. Of course, what are they looking for? They're looking for cuts, because if they're not going to increase anymore, they know cuts are just around the corner. The Federal Reserve must be open to the possibility that the economy will begin to re-accelerate rather than slow, with potential implications for the U.S. central bank's inflation fight. This is according to the Fed president, Barkin. And something that would be very different than what you hear from a lot of the analysts. We're getting that right from the Federal Reserve, okay? It includes a possibility that inflation stays high and the economy softens. If I got convinced that inflation was remaining high and demand was given no signal that inflation was going to come down, that would make the case for further tightening. So they're just laying that out there, letting everybody know we might have to do more tightening. But we're kind of at this point. Like, if we're not at the very end, we're coming close. What does that mean, though? It is very clear that they're not ready to cut interest rates. So program that into your decisions, that rate cuts are not here yet. We need a catalyst. Why are they cutting? They need some sort of catalyst. Maybe more banks start to fail. Maybe you've got problems outside the country that start to spill over. Could be something in China. It could be something in Europe. But until that moment, they're not cutting. So don't go out there and start buying real estate or buying something with the expectation, no, I know what, 6 months from now, rates are going to be cut. I guarantee it. Well, you don't know. You really do not know, because if they allow this moment in time to occur where they're actually going through another round of quantitative easing, and this is going to be so devastating. I mean, it's going to punish people. It'll make everything we've seen in our lifetime seem like nothing, because inflation hasn't come down yet. And you reignite that, it is going to be a very big issue. I'm hopeful that that does not occur. Okay, look at this, deficits. Yeah, we can look at the quantitative easing, but also from the government side, they're pumping in so much cash over these last few years, expanding the amount of currency out there by unheard of levels. Yeah, you're going to have a problem with deficits. You try to do deficit spending, and guess what? Long term, we've seen this before. For every dollar that goes into the economy, you get less out. So it's like a drug addict that, yeah, they need more and more and more, or an alcoholic. One beer might have been enough back in the day, but then it became three, and then it became 12, and then suddenly they're having a 2-4 just to feel a buzz. Okay, so there is an issue with that. When you become desensitized, it's the same thing that the drug addict or the alcoholic feels, with what goes on with the fiscal and the monetary. They need more. They need more of that drip. All right. And then we have this S&P 500 flashing a correction signal not seen since the early 2000s. We've got many of these that are coming up, but the bond market is the one to watch. I think it is extremely important. And so we got to look at more into this. And I believe it's important to analyze this in depth. So this is what Powell was talking about. We are attentive to signs that the economy may not be cooling as expected, with consumer spending especially robust and the housing sector possibly rebounding. And look at it. You've got the job scenario, you've got the houses, you've got everything that is actually heating up in some cases, at least based on their metrics. We know that there's a whole different story. But when you look at it, unemployment is super low, job scenario, oh, your jobs are so abundant. And so they've got an issue because inflation can't get down to their 2% target while this is going on. And so they're kind of like, we got to maybe increase a little bit, or we got to, can't cut at this point here, and we got to still wean off the balance sheet. But as the balance sheet comes down, I need you to understand this. As this balance sheet comes down, that starts to throw everything off. If you remember what occurred in 2018, the balances started to fall, and they said we didn't have enough reserves. We didn't have enough reserves to run this system, and they started apologizing. Can you believe it? And then they were pumping in cash. It didn't take very long, did it? They started to apologize. I'm sorry. We apologize. And they started to, realize that, I think they got it down to about $3.6 trillion in their balance sheet, and they needed to reverse course very fast. And so they did. And that is the way it works. So we know that, unfortunately, for a lot of people, they don't realize that a lot of inflation is coming their way. You've got to plan accordingly. Plan more for inflation than deflation, let me tell you. The Fed should carefully aim for a higher inflation target. This is what they're going to do, I believe, over the long term. Hey, we're not going to get it down to 2%. Let's just say 3%. Come on, okay? 3%, or maybe a range 2 to 3%, and 3% being okay suddenly. I don't know why any inflation is good, but here we are. This is the wacky world we live in. And now something for everybody to realize. U.S. Steel is the first $1 billion company, and it's nearing an end. It's a lesson for Tesla and Apple. And so the biggest companies that you have today, these are the biggest. You use them every day of your life, maybe. And yet, at some point, that company will likely go bankrupt. Jeff Bezos himself said Amazon one day will go bankrupt. It's a matter of time. And thinking about this right now, Apple, Amazon, Tesla, all these companies, how can you even fathom that would occur? And yet, on a long enough timeline, the likelihood of a company being bought up, split up, failing, whatever the case is actually highly likely. It's unbelievable. So just keep that in mind when you're doing your analysis. You've got to be much more, let's just say, less emotion. Don't use emotions when you're investing. It's all about the money. It's all about what you want to achieve, preserving wealth or gaining more. Whatever it is, when you put those dollars in, make sure you realize what your goal really is. Okay. Norway's wealth fund, by the way, the biggest investor in the world. Like if you want to say who's the biggest investor in the world, Norway's wealth fund makes $143 billion profit as AI surge lifts tech. Now, absolutely, that's the headline, right? And that is true. They're investing in tech stocks. We know that they are, just like the Swiss National Bank. That's the central bank of Switzerland. They operate like a hedge fund. So Norway's wealth fund, by the way, they cut their exposure to tech. They said, hey, we made enough money at this point, because I think they lost a whole bunch that didn't look so good that year. They then realized that the stocks went up and now they're taking profits. Now they're saying, okay, kind of evened out. They cut their exposure. That's the important point, but that's not going to make the headlines. All right. Look at this. I mean, there's so much here, but we can see the Magnificent Seven market cap as a percentage of the S&P 500, just showing us that we're kind of topped out at that point right here again. This is your typical tech stocks looking at this. We used to have the FANG. Now they got this, the Magnificent Seven. Anyway, the point is you've got these big stocks, big names concentrated into the market and really pull the whole thing, whether that is up or down. But that seems to be the way it goes these days, right? It's just crazy, but that's where we're at, where there's so much concentration. Now, what I want from you is to join a group of like-minded people talking about stocks every day, talking about real estate every day and the economy, everything. Everything is right here in the Discord group. You can go down below and join. It's totally free. Okay, you're going to be able to communicate with me directly. Very important. Hit that link in the description, okay? I want to see everybody on there. This is the comment of the day. Thank you very much, Canberger. I like the way Congress rejects the CBDC, but the Fed just goes ahead regardless. Guess we know who's in charge, and it ain't the people. And that is absolutely true, isn't it? Nobody asked for a central bank digital currency. Nobody wants it. And that's why they're just going to do it, implement it, and hey, it's there. I believe it'll be in a crisis moment where the UBI, Universal Basic Income, will be required. They could say this is the lowest cost way for us to implement it. And they say, yes, absolutely. They talk tough. Congress talks tough, but ultimately we know, the way this works. All right. I want to thank you for being here today. I want you to really take what we've shared here and really try to make sense of it all. I know it can be complicated sometimes. If you have any questions, just reach out to me through the Discord and I will get those answered right as soon as I possibly can. I'm in there every single day. All right. I'll see you on the next one. Take care.